Good morning. It's Friday, November 9th. I'm today joined here with Althea. We are basically ending a week which gave us the US election result, and the market seems to have returned to the old themes. Overnight, we're seeing some weakness emerging once again in Asia. If you look at the chart here, we can see some of the China data. We've seen some China data which is worrying the market a bit, and you can see some of the currency movements overnight. The Australian dollar, which has been on a tear recently, is starting to give back some of its gains. Aussie dollar quite often used as a proxy for what's happening in China. And if you look at the Chinese renminbi, the offshore one on the right hand side, we're slowly grinding our way back up towards this critical $7 level, which has caused some nervousness in the past. So data from China is not really supportive at this stage, and that's creating some uncertainty. If we return to the US market, just looking at the chart here, we've obviously had a very strong recovery in the US market. But as you can also see in terms of Fibonacci levels, we have reached a key level here. Also the correction high that we had back in early or middle of October. So 28.11 is really going to be a focus today as we look at whether this level is going to hold the market back. But I think, Althea, we had the FOMC meeting yesterday. What's your key takeaway from that one?
Well, yesterday we have seen a Fed that has been very much relying on data. It seems almost, Ulla, that they didn't even consider the midterms election that we had a few days ago. So what happens is that Powell says that the economy is still supported, and the kind of words that he used is that he's going to continue to gradually hike interest rates and tighten the economy. So at this point, we will see definitely like a rate hike in December, and this can have some serious consequences on the yield curve. We have a graph here with us that shows since the beginning of the year until today the 10 years and the 2 years yields above, and below in green you see the spread between the 10 years and the 2 years yields. So the main takeaway here is that since June until today, the spread between the 10 years and the 2 years has been trading range bound, and between let's say 19 basis points and 29 basis points. But what is interesting, what you can see on the top part of this chart, is that the 2 years has been basically rising faster than the 10 years. And now with Powell hiking or continuing with his policy of hiking interest rates, we can expect the 2 years to continue to rally in yield. But the longer part of the curve, I believe that is going to be subdued, because now we have a president that basically cannot really
increasing spending further.
Exactly. Yeah. So he's going to be tight on fiscal policies. He cannot do anything, and he's going to focus on what he can do. And what he can do is basically influence foreign policies. And I believe that at this point we will continue to see him talking about tariffs and increasing a danger of a trade war that will keep the longer part of the curve at this given or take 10 basis points more or less.
Yeah, there's no doubt if we just look at the 10-year notes that we climbed up to 324-25 area yesterday. That's more or less the highs that we had back in the summer. But now we are basically this morning just a couple of basis points softer in response to the weakness that we had overnight in China. Next week, Althea, we're going to have a lot of CPI data, inflation numbers coming out, but it looks like Hungary jumped out a little bit early yesterday, and we saw a bit of surprise there. Can you explain what happened there?
Yes, absolutely. So what happened is that yesterday we have seen CPI numbers of Hungary shooting up above expectations. We have a graph here, and as you can see, we have in red the CPI numbers of Hungary that came out yesterday around 3.8%, and in blue instead you see the Hungarian government 10 years yields. So what happens is that the real yields is basically eroded. And I believe that this is a first sign of weakness in the CEE region, And on the top of that, we are having some slowdown in the European Union. Yesterday, we have seen the European Commission that revised down growth data for 2019 and 2020. And I believe that these could have serious consequences for the CEE region that has been relying upon the growth of the Eurozone
and
for so long.
Yeah, and some of that European growth decline is probably due to the trade war and due to what's happening in China right now, Europe being such an export-oriented economy. Thank you very much, Althea. The repercussions that we've had in the commodity markets has also been felt. Copper is trading down by 1% this morning, but really the market that's attracting most attention within that space is the crude oil market. As you see on the chart here, we continue to trade lower. This morning we have now seen we're entering basically a fifth weekly loss, and WTI crude yesterday, and that's the headlines this morning, as you'll probably find that we entered the so-called bear market in WTI. We're down more than 20% over the past 6 weeks, and so just from the beginning of October. So it's been quite a phenomenal sell-off we had, and it's taken the market, I would say, quite a bit by surprise. If you look at the chart, you can see Brent crude on the left there. That's really the critical level, the 70 area today, which we have come very close. We got rising production. The stocks are rising as well. We got the waivers that has been put in place in order to reduce the impact of Iranian sanctions, at least here in the short term. So it's returned the focus to OPEC, and we got the OPEC Russia JMMC meeting this weekend in Abu Dhabi, and the market will obviously be looking for signs of production starting to be cut as we move into 2019, given the fact that we are seeing this weakness right now. There is a speculation in the market that Saudi Arabia and Russia probably will try to defend the $70 level. We prefer the $70 to $80 area, but as we saw, the break above 80 was extended quite a bit. The market can easily overshoot to the downside as well, so quite critical, this 70 level over the coming days here in Brent crude. And then just before the calendar, just taking a look at the Worcester report that we had out yesterday. The headline data was okay. You can see some of the changes. There was some big up revisions in soybean ending stocks, and you can see those charts here on the right. That's the bottom right, which is soybeans, which continues to move higher due to a trade war with China, which is leaving stocks at home in the US. They can't export at this stage. That's increasing stocks, putting pressure on the price. But if you look at corn, there was a huge increase yesterday. That's basically due to an up revision from China, and the market is really questioning the quality of the data from China. So that's why if we look at the price reaction yesterday, we had a bit of a whipsaw, both initially just rising on the headline and then coming down on the details, but finishing the day relatively unscathed. So quite a bit of a report yesterday, but overall, the key worry still for soybeans is the trade war and the fact that they can't export enough of their production, which is at a record high. Right, let's finish off with the macro calendar. Today is really a lot of focus on the UK. We got trades, we got manufacturing production, and we got Q3 GDP. GDP is probably expected to rise by 0.6 in Q3. That's a 1.5% rise in the year. And then later on in the day, we have some speakers, and we also got the Michigan survey. That's leading up to next week, where we got, as I mentioned, CPI data coming out from several countries, and we also got a speech from Chairman Powell on Wednesday. And what I didn't put into the slide here was the OPEC Russia meeting this weekend, which could be quite important for oil markets as we head into next week. Okay, that's it from us. We will be back again on Monday. We wish you a pleasant weekend. Thank you very much.